Welcome to the FedLife Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
And hello and welcome to this episode of the FedLife Podcast. I am your host, Dan Sipe. Additionally, I am the branch manager here at Lee Sipe and Associates, and more importantly, Serving Those Who Serve. I want to begin, as I always do, by saying thank you for listening, and also thank you for your service. You don't hear it enough, you'll always hear it here. The one thing you're always going to hear here is our friend Ed Zurndorfer. The guru is back with us again as part of our ongoing mission to reach, teach, and serve you. At the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. If you do not have a personal advisor, hit us up at Serving Those Who Serve, and we will do what we can to help you. Once again, we're going to follow Ed's FedZone articles to give you one more way that we can reach you and teach you and serve you. And I think some of the topics in this series will be of interest to a lot of Feds because we're going to dive into being a reemployed annuitant and compare and contrast that with phased retirement. And finally, we'll round out with taxation of employer-sponsored life insurance, since October is Life Insurance Awareness Month. Right, Ed?
That is correct, Dan.
So let's get to it. All right, Ed, let's hit the basics of reemployed annuitant in general, and then we can dive into any differences between CSRS and offset and regular FERS. So we won't be covering anything with special provisions in this one. So I guess number one is the Fed has to retire, right?
That is correct. They have to retire under a regular, normal retirement. They cannot retire early and then come back and work. They got to retire under a regular, normal retirement.
Okay. And any other requirements there?
Well, the requirement is that they have to be hired by a federal agency. It's not a given they're going to be hired.
Sure.
An agency wants to hire employees, and I think this was really, in the past, one of the tools that federal agencies were using to get experienced people to come back to work.
Sure.
I remember post 9/11 where agencies were really looking for people with some security background that they wanted to hire them back because they had the skills really needed in this new age coming about as a result of 9/11, and the employees had the skills that were really needed, and federal agencies wanted to take advantage of them, so they gave them an incentive. Well, you can come back, still draw your annuity, and we're going to pay you. We're going to pay
Gotcha.
you in addition to you're getting your annuity with very few restrictions.
Right. And really kind of the only thing that would cause the annuity to stop is if they were out on a disability retirement, which makes sense because if you're able to go back to work, you're not disabled, correct?
That is correct. I mean, disability retirement, Dan, is something very special. It's not a given if you're disabled that you're going to be able to retire under disability retirement. But let's face it, if you are disabled and you qualify for disability retirement, the whole point is that you really cannot work gainfully, like full time or something like that. So it really doesn't make sense that somebody would be hired back as a reemployed annuitant if they're getting a disability annuity. It just doesn't make sense.
Gotcha. And so let's go ahead and dive into FERS to begin with, because that seems to have the fewer moving parts. So a retired FERS is interested in coming back to federal service, and more importantly, there's an agency that wants them to. So their salary will be impacted by that annuity, correct?
Yes, Dan. The general rule is that if you're hired back as a reemployed annuitant, you're going to receive your full annuity. When you retire from federal service, you're going to be getting either a CSRS or FERS annuity. We're talking now about a FERS reemployed annuitant. So This individual is going to get their full annuity, and then when they start working, they're going to get paid by the federal agency. However, their salary that they're receiving will be offset by the amount of their annuity. For example, let's suppose their annuity, let's say, is $5,000 a month. I'm just taking an even figure, $5,000 a month, and the agency wants to pay them $3,000 a month to be a reemployed annuitant. This is their salary. Well, their $3,000 salary will be, I should say, they're getting $5,000 salary and a $3,000 a month annuity, $3,000 a month annuity,
yep.
And they're getting, and then the agency is going to pay them $5,000. That being said, their real salary, their net salary, I should say, will be $2,000 because that $3,000 annuity is going to offset the $5,000 salary.
And you note that it would really be a rare circumstance that they got paid both, correct?
It does happen. There are some exceptions in which the salary it will not be offset. I'm just going to give you a few of them. For example, the exceptional circumstances, it's called comparable pay standards, something like that. But that's very rare. It's very rare.
Sure, I'd imagine that's somebody with very, very narrow specific expertise, and they really, really need them back. And in that case, they'd get the full salary. So moving forward, so they've already retired. They've come back to work. They can actually accrue a supplemental FERS annuity, correct?
Yes, if they work for a minimum 1 year as a reemployed annuitant, they have the option of receiving what's called a supplemental annuity. In other words, they earned their first annuity when they retired. Mm-hmm. And if they work a minimum 1 year as a reemployed annuitant, they can earn for themselves another annuity. That annuity will be based on the additional years that they worked, and in so doing, they're going to be able to increase the amount of their annuity.
Gotcha.
Total annuity.
And you were thorough as usual, brother. You showed all of the different costs for that supplemental FERS annuity. So let's just focus on the folks that we'd be talking to, that would be looking at it right now. Since 2013, it's 4.4% of pay, so they're sort of like a FERS fray, correct?
Well, Dan, we got to be careful here because when the person retired initially, mm-hmm. they had worked a certain number of years, let's say minimum 20 years. Let's say 20 years.
Gotcha.
And depending on when they were hired initially, when they came into federal service, would determine the amount of their paycheck being deducted every pay date to put into the FERS retirement and disability fund. Somebody hired before January 1st, 2013. 0.8% of their paycheck was being deducted every 2 weeks,
right, and
contributed to the FERS Retirement Disability Fund. If anybody was hired during the year 2013 as a new employee, they would be contributing 3.1% of their paycheck, and anybody mm-hmm. hired after December 31st, 2013 would be contributing 4.4%. So let's take someone who was hired into federal service, let's say initially in 1990, and then
Gotcha.
they retired 30 years later in
Gotcha.
2020. Well, their whole retirement, their annuity was based on the fact that they were contributing 0.8% of their paycheck throughout
Sure.
those 30 years. If they got rehired as a reemployed annuitant, and they also are contributing to FERS, because this is what the supplemental annuity is all about. You're going to be paying for this because a part of your paycheck will be contributed to the FERS Retirement Disability Fund. So when they retired, they were contributing 0.8%. They will also be contributing 0.8% as a reemployed annuitant.
Oh, wow. Okay, that's good.
Let's say somebody was hired during the year 2013, and they retired with 7 years of federal service, let's say in 2020, at age 62, and they're going to get rehired as a reemployed annuitant, then they will be contributing 3.1% of their paycheck
Gotcha.
as a reemployed annuitant, because that's what they were contributing when they were in federal service.
Well, I guess that's fair. So you mentioned that they need to stay at least a year, but if they stay 5 years, they sort of have two options for how they can receive that supplemental annuity, correct? They can have a recalculation?
Yes. Let's keep in mind that if someone has worked as a reemployed annuitant under FERS for a minimum 5 years, they have the option of having their annuity recomputed, redone. Now, why would somebody want to do that? Well, let's consider this, that when the person was hired as a reemployed annuitant, they were supposedly at a higher salary than they were when they were working. That's one of the incentives of coming back. And if they work a minimum 5 years, chances are their high 3 average salary, which would be used to compute their annuity in general, would be higher compared to their high 3 average salary when they initially retired. And that high 3 average salary would be used now to recompute their existing annuity. Also added to their service time, total service time, would be the additional unused sick leave they accrued when they were a reemployed annuitant. So that's going to add as far as service time. In other words, it could be more than 5 years. If somebody worked 5 years as a reemployed annuitant, and they had, at the time they decided, now that's it, I'm not going to work anymore, I'm going to stop my reemployed annuitant status, I'm just going to retire finally, and they had 6 months of unused sick leave. Well, 6 months of unused sick leave is half a year. That's going to add another 0.5% of their high 3 average salary to their recomputed annuity. Let's keep in mind that when you compute your annuity, we're going to take the years of service that the individual had before they retired, when at the time of their retirement, before they became a reemployed annuitant, and add to that the additional years of service that they had as a reemployed annuitant, plus all the unused sick leave. It could really increase the size of their annuity. But keep in mind, Dan, that in order to get this recomputed, redetermined annuity, so to speak, you have to work a minimum 5 years as a reemployed annuitant. Anything less than 5 years, they'll not recompute your annuity.
They're going to pay Social Security and Medicare taxes from the new salary, naturally, correct?
That is correct. But Dan, let's keep in mind. That's good. That's very good. I mean, a lot of people, I got to pay that Social Security tax. That's 6.2%. I got to pay that. Well, that's to your advantage. Why? Because the more you pay into the Social Security system, the higher are going to be your benefits. Social Security every year is computing our benefits. They're computing it every year. They're basing it on your 35 highest years of salary, whenever they work. So this reemployed annuitant, when he or she comes back, they're continuing to work and they're paying to Social Security, their salary could be much higher than what it was 35 years ago when they were working as an employee, which means that their benefits are going to be going up. And if they're drawing Social Security that at the time they're reemployed annuitants, let's say they've reached their full retirement age, they're going to get a retroactive increase in their benefits. I want to point that out. That we talk about this during our Social Security webinars, that when someone's drawing Social Security, like myself, and they're still working, Social Security is still recomputing your benefits. I just got my notice. By the way, this past week, that they're making my benefits higher retroactive to last January when I first started drawing Social Security when I was 70 years old. They said, we're going to increase your benefits because you've paid more into the system based on last year's earnings.
Sure.
It's amazing how it works. So this is their advantage.
It's like having another birthday.
That's right.
So, okay, you did a pretty good job of explaining how the pension basically offsets within the salary. But in your article, and folks, by all means, head over to the FedZone, fed-zone.com, and always read Ed's article too, because it's chock full of calculations and examples. You have one example in there where somebody ends up with a zero salary. Is that really going to happen? Because I don't think somebody's going to take that job.
I think it is possible because the amount of their annuity is exceeding the amount of their salary, so the offset will result in zero. But you got to keep in mind that even though they're not getting a salary, maybe one of the reasons they're not getting a salary is because the reemployed annuitant is contributing part of their salary into
DSP,
the thrift savings plan. That's another thing we got to keep. That's another benefit of being a reemployed annuitant, that you can contribute part of your salary into the TSP. As long as you're working for the federal government, you're always eligible to contribute to the TSP, whether you're just a regular employee or a reemployed annuitant. You're getting a salary that allows you to contribute to the TSP with no age limitation.
Gotcha. So now let's jump to that supplemental annuity calculation. So you mentioned in the article, what are supplemental annuity credits?
Supplemental annuity credits are in terms of in terms of your service time. The service includes all periods of actual full-time and part-time service, plus length of service represented by any unused sick leave hours the reemployed annuitant's credit earned during the period of reemployment. What this means is if you're working full-time, you're working part-time, but not intermittent, any amount of service is going to give you credit for purposes of calculating your supplemental annuity, and then plus any unused sick leave.
And so I noticed it's a flat 1% a year for that calculation. So there's no bump for being past 62 like a traditional FERS would see.
That is correct. When you normally, on a regular retirement, I should say, if you retire at age 62 or older with a minimum 20 years of service, the accrual factor, if you will, is for every year of service, you get 1.1% of your high through average salary. Mm-hmm. That's not going to be the case here in the case of a supplemental annuity. You're going to get a flat 1%. That would be the case, however, when it comes to the redetermined annuity, because with the redetermined annuity, they're taking all your years of service, including the years that you worked as a reemployed annuitant, and that would mean that if you add up those years, and it exceeds 20 years and you're over age 62, your redetermined annuity would be calculated using a 1.1% accrual factor.
Now, you also point that those supplemental annuity credits will be based on average salary. So walk us through that, because your example shows somebody, working a full-time schedule and a part-time schedule and that type of thing. So explain how that all works.
The average salary is the average of full rates of basic pay in effect during all period of reemployment. Even though the person might be working, let's say, half-time, but they're using the salary as if it's full-time salary, but it's going to be prorated according to the number of hours they work. It's a little complicated. I have an example to make it a little bit easier. So I think it's a lot easier if our listeners check that article.
100%.
In the Fed Zone. It was the October 13th Fed Zone column that talks about understanding the rules for reemployed FERS annuitants. And if they look at that example, they'll be able to better understand how this average salary is calculated.
If it's supplemental, it'll be in addition to the original FERS annuity, so there can be a survivor benefit on it too?
Yes, a reemployed FERS annuitant, but they must have elected a reduced FERS annuity to provide a regular FERS survivor annuity in order to have an additional survivor annuity for the FERS supplemental annuity. In other words, if the FERS annuitant, when they retired and decided not to give a survivor annuity, usually to a spouse, of course, has to sign off on that they're waiving a survivor annuity. They cannot turn around and give a survivor annuity for a supplemental annuity. They cannot give a survivor a supplemental annuity, so to speak. But the reverse is not true. And what I mean by that, if a reemployed FERS annuitant is giving a survivor annuity for their first annuity when they retired, they do not have to give a survivor annuity for the supplemental annuity, and they do not need their spouse's notarized consent for that.
Gotcha. That makes sense. Okay, and I know you'll be touching on this in our next webinar where we're talking about phased retirement, but I'll just touch on it here. So they wouldn't be able to be in the flexible spending account, and their FEHB premiums would be coming out of the original annuity, not the new salary, correct?
Yes, that is correct. And in a way, that's not good, because they're still going to get their full insurance, their full health benefits. But when you're an annuitant, your health insurance premiums, we're talking about the Federal Employee Health Benefits Program, are deducted from your after-tax annuity.
Gotcha.
Each month, after-tax annuity. When you are an employee, your premiums for health insurance, the FEHB premiums are being deducted biweekly from your gross salary. It's called premium conversion. It's a little cheaper, therefore, to have it deducted pre-tax versus post-tax.
Sure.
A reemployed annuitant does not have that option. But as we'll find out later, a phased retirement individual can have that option of having their health insurance premiums deducted from their pre-tax salary, And
Gotcha.
of course, a reemployed annuitant cannot participate in the flexible spending accounts. Retirees cannot contribute to a health care or dependent care flexible spending account. We're going to find out that a phased retirement individual can contribute to the FSA.
Okay, well, our CSRS folks have been pretty patient, so let's dive in for them. And in reading them both, the initial eligibility rules are pretty similar. The CSRS retiree could switch to FERS as part of reemployment. Why might somebody want to do that?
One reason would be that to maybe get some Social Security credits. Maybe they worked their entire career under CSRS, and they're getting a nice CSRS annuity, but they would also like to get some more Social Security. Maybe they don't have 40 credits of Social Security. They're not getting any Social Security.
Gotcha.
So now there's an opportunity now to work a few years, build up, get some more credits, and be eligible for Social Security.
Okay.
That might be one reason, because FERS employees are covered by Social Security. CSRS employees are not.
So then would they have a supplemental FERS annuity to go along with their CSRS?
That's correct. They would assuming they have at least 1 year of service as a reemployed annuitant, they could earn for themselves a supplemental annuity, but it would be a supplemental FERS annuity.
Gotcha.
It really wouldn't be supplemental, because it's really an annuity, because they're not supplementing their current CSRS annuity.
I'm with you. And so they also could opt for a supplemental CSRS annuity as part of this reemployment.
That is correct. But I got to tell you, Dan, it's a little more complicated when you are CSRS as far as being a reemployed annuitant. There's some rules that they got to keep in mind about that.
Well, take us through it.
Well, one of the rules here, a reemployed annuitant status has to, first of all, if they owe any deposits, that includes deposits for, let's say, temporary service. If a CSRS employee was hired before October 1st, 1982, and prior to their being hired as a permanent employee, they had some temporary service. The good news for the CSRS employee is that they're going to get credit for both eligibility to retire and in the computation of their CSRS annuity, whether they make a deposit for that temporary service or not, they're going to get automatic credit. If they do not make that deposit, then they're still getting credit for that temporary service, both for eligibility to retire as well as in the computation of their CSRS annuity. But the amount of their annuity is going to be reduced by 10% of what they owe. 10% of what they owe.
Gotcha.
If that same CSRS individual retires, comes back, wants to be a reemployed annuitant as a CSRS, they have to make that deposit first before they can get employed as a reemployed annuitant.
Interesting. So another reason why they might go FERS.
That's another reason they might go to FERS. That's correct. Also, and this applies to FERS as well, that if a CSRS individual had prior military service, they're getting credit both for eligibility, maybe for computation, depending on when they were hired into federal service. I got to tell you, Dan, when it comes to military service and CSRS employees, it's very complicated. Sure. I go through this during my CSRS webinars, and I think some people just fall on the floor in terms of the complexity of this stuff. But let's say they do owe a deposit for their CSRS service, and the same thing is always true for FERS. A FERS employee has the option of making a deposit for their military service, and if they get hired as a reemployed annuitant and they want to make that, they really would like that military deposit, they have to before they can get hired as a reemployed annuitant. And one other category here is that if a CSRS employee or serves offset, I should say serves offset, because we can't forget about our serves offset individuals. Sure. If they get hired, if they want to get hired as a reemployed annuitant and they owe a redeposit. Redeposit means that same CSRS employee or serves offset individual at some time during their career left federal service and withdrew their contributions that they had put into the CSRS Retirement Disability Fund, and then they came back. They have not redeposited that money. Then once they retire, they're going to get, depending on when they withdrew the money, they're getting credit both for eligibility and for computation. However, if they come back after they retire and they want to be a reemployed annuitant as a CSRS reemployed annuitant, they have to redeposit that money they took out.
Once again, much like FERS, that annuity is going to be calculated based on an average salary. But there's a funny wrinkle, if I read this correct, and stop me if I'm wrong. You begin your CSRS accrual just like you started in federal service again, meaning that the factor for the first 5 years is 1.5%, even though at the end of that person's career, they were up to 2%, correct?
That's correct. They have to, for the first 5 years of federal service, you're in the calculation of your CSRS annuity. For the first 5 years of service, you get 1.5% of your high 3 average salary for the first 5 years. You work 5 years in the federal government under CSRS and you retire, you're going to get 7.5% of your high 3 average salary. Then between year 5 and year 10, year 6 through 10, you accrue 1.75% of your high 3 average salary for every year of service. So if you work 10 years under CSRS or serves offset and you retire, let's say at age 62, you're going to get 16.75% of your high 3 average salary. Once you reach year 10, though, for every year of service thereafter, you get 2% of your high 3 average salary.
Gotcha.
Now, this is going to make for real complications in terms of calculating the supplemental annuity. And the reason I say that is that, let's say somebody, and this is my example, by the way, that someone who retired with 9 years of service, Dan, under CSRS, she retired at age 62, then she got employed as a reemployed annuitant, again, CSRS. And then after 3 years of service as a reemployed, 3 years of service as a reemployed annuitant, then she decided to call it quits. And she's now is eligible for a CSRS supplemental annuity. How is that supplemental annuity? How are they going to calculate it? Well, she has average salary. And she has 3 years of service, and let's say there's no unused sick leave. Let's leave that aside. There's just no unused sick leave. I want to make it as simple as possible. Well, since she has 3 years, we're gonna remember that she only had 9 years when she retired. So that first year, the accrual factor in the calculation of the supplemental will be 1.75%, because she still does not have up to this point she does not have the 10 years. Once she stops working as a reemployed annuitant, now we're going to take that 10th year, I should say that year 9, and that'll be the year 1 of the reemployed service, and multiply that year by 1.75%, and then for years 2 and 3 of her reemployed annuitant service, she gets 2%. It is crazy. It's complicated, but my example shows that it's a lot easier if the listeners read that column was the first column in October 5th, where it talks about understanding the rules for reemployed annuitants who are CSRS and serves offset. Gotcha.
And so just like with FERS, have the option for survivor annuity, assuming they would have had to elect it on the first one, just like with FERS?
That is correct. Same rules, and the same thing with the redetermined CSRS. If you work a minimum 5 years as a reemployed annuitant under CSRS, you can have your annuity recomputed, your existing annuity recomputed. But one thing you got to be careful though in terms of the rate calculation in terms of redetermined CSRS annuity. When the CSRS annuitant CSRS reemployed annuitant initially retired, they had to have met the minimum requirements for a regular normal retirement. The reason I'm saying that is if, let's say, this reemployed annuitant retired under a voluntary early retirement, a VERA or VSIP. They went out early. My example is somebody retired at age 47 under CSRS, had 25 years of service. The agency was offering early out, retired. And then he's reemployed a year later, okay, at age 48, and then he worked 5 years until he was age 53. In this case, the individual would not be eligible for a redetermined annuity because he did not meet the requirement of retiring at age 55 with 30 years of service. He's only 55. He's only 53 when he finally retired. He would not be eligible to retire if this was a regular normal retirement because you have to be a minimum age 55. He is 2 years under age 55. So in this case, he would only be eligible for a supplemental CSRS annuity, not a redetermined annuity. Dan, the devil's in the details, as I say.
Oh, always is. That's why we have webinars, though. So, and the same rules about TSP, FSA, FEHB as our FERS friends, correct?
Same rules for TSP, FSA, FEHB. Everything's the same. Got it.
All right. So, any last word of advice relative to recommendations about reemployed annuitant in general, whether you're CSRS or FERS?
Absolutely, both CSRS and FERS. Anybody who's interested, CSRS annuitants are interested regarding their retirement status should, in terms of and the possibility of re-entering federal FERS as a reemployed annuitant. Please check with the agency. Please. Ideally, they'll check with the agency that they retired from to see if they would in fact be eligible for to be rehired as a reemployed annuitant. And annuitant is required as a condition of reemployment to advise the agency whether he or she is in receipt of annuity, a CSRS or FERS annuity. It also has to tell the agency that they want to get reemployed at the gross amount of the annuity, and also it's very important that the hopefully reemployed annuitant has to tell the agency whether they're receiving an annuity based on what's called an involuntary separation. In that case, they're not going to be eligible to get hired as a reemployed annuitant, either CSRS or FERS. And one final thing here, when a reemployed CSRS annuitant wants to finally retire after their reemployment service and they're going to apply for a supplemental or a redetermined annuity, they have to fill out a form. It's standard form SF2801, application for immediate retirement. And a FERS reemployed annuitant, when they want to finally retire and apply for a supplemental or redetermined annuity, they have to fill out form SF3107, application for immediate retirement for FERS employees.
And actually, there's one more piece of advice, and that is to listen to the next podcast to learn about phased retirement, so you can compare and contrast between the two, right, Ed?
Absolutely. It's very important that employees who are thinking about either reemployed to become a reemployed annuitant or to become a phased retirement individual consider both options if they're there. It's not a given they're always going to be there, but it's important. If they are, you have to sit down and understand the differences.
Gotcha. Brother, I still don't know how you keep all this in your head, but I'm very grateful that you do, and I appreciate everything that you do for us as far as raising the level of our team. It's really a blessing. So I thank you for that, and I thank you on behalf of the feds. Well, folks, that is a wrap. We are serving those who serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. And remember to share it with friends and strangers and neighbors and everybody. Check us out on Twitter and LinkedIn. Don't forget our live webinars every week. Just go to stwserve.com and you'll see the webinar button. And click on that. We have a ton. The guru comes to you as we work to reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Share it with your friends. They will thank you. Be sure to read Ed every week in the Fed Zone and also at stwserve.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your FedLife. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organization.